So today we're going to talk about the bad news that is out there for stocks. At the moment, there's a lot of bad news out there with the Q2 earnings season underway. And today I'm going to show you some of the bad stuff that's going on in the stock market at the moment. There was actually that much bad news that I had to be quite selective on the ones that I showed you. But I said it a few days ago, I think for a few weeks now, I'm normally a bullish person on the stock market, but the information, the data that I'm seeing at the moment in the stock market and the economy is getting a little bit concerning and worrying. And if anything's to go by this week, some of the information that's come out is once again adding fuel to the fire of it's getting a little bit tough and a little bit worrying out there. So I hope you enjoyed the video, guys. If you could hit that like button, really helps out on the YouTube algorithm. Apart from that, let's get started on today's video. So a few days ago, I made this video on YouTube as a bit of a response video to give you some actual information about what is going on out there in the stock market. Could I see a crash coming? And my answer to that was, I don't know. I ain't got a crystal ball, but what I am seeing is making me a little bit more worried about the stock market and the economy. And obviously we've got into Q2 earnings season. We've got into Q2 earnings season in the last 5 days, 10 days, whatever you want to call it. And the information we are getting, in my opinion, is even more concerning, that things are going a little bit in the wrong direction. And those higher interest rates, that inflation pressure has really started to kick the consumer, and it's really affecting the spending. And every company that I look at that is very consumer orientated is getting a little bit weaker. And if you look at the S&P 500, it was down 2.3% yesterday. That was an awful day for the S&P 500. Gotta point it out, it's still up 14% year to date, but what it does mean is the S&P is now down 4.2% from its all-time highs, which means that we are halfway to a correction and we are a quarter of the way to nearly a crash at the moment. So we'll see if what is officially recognized as a correction, a crash. A correction being 10% down, a crash being 20% down. So we'll see if it does get a little worse from here. Now, obviously, really tough day, worst day since 2022, and obviously some of you guys, most of you guys that's probably watching this video, I'd say a lot of you guys went through that 2022 stock market. It was a brutal time. Stocks were down a lot, especially small market caps. They were down for a good 18, 24 months. A lot of them small market caps got absolutely destroyed, and some of them are still yet to recover. The big tech has recovered, but there's still a lot of small caps that have still suffered really since 2022. And it was a tough time. One of the worst stock markets, the worst stock market we've been through since 2008, and it was a brutal time. Some of you guys that have made it through it, well done. You stuck through it in the end, and I'm sure you have been getting the rewards over the last 12, 24 months. A lot of people that went through that 2022 stock market crash that were relatively new investors, retail investors, they're not watching this video. They quit the market. It was that tough that a lot of retail investors ended up quitting the market. Or even worse, what we saw is some of those 2022 stock market investors actually turned as perma bears. It was that brutal that they were like, hold on, this is the normality, betting against the market, betting against all these companies. And obviously, some of them have gone very quiet in the last kind of few years as the stocks have gone on to rally. But you'll see very quickly, as soon as the market turns negative, the first thing is how fast stocks go down. I think people forget. We see the stocks gradually go up, but as soon as you get that bit of fear, boom, the stock market does move down so fast. A 2.3% drop in one day, it's like a click of a fingers. It just goes down so fast when that fear takes hold. Fear is the biggest emotion in the stock market. I tell you this all the time, guys. It is why stocks can drop down so fast. You're like, wow, what's happened there? But also just how quick the fear can take hold of situations. People, you see this all the time. We saw that in 2022 when we had that horrible dip, is that everyone was going, yeah, next time there's a crash, I'm going to buy the stocks. And then 2022 came, and how many people were there still buying the stocks in the dip? A lot of people that said they were going to buy the dip didn't buy the dip. And the other thing is the media. How quickly do the media take all of this sentiment, all this negative sentiment, and they really push it out. They do not wait to push the fear out there as well, because it's good for them. It's good views. It's same on the YouTube side of it. The view difference between saying, oh, it's a really good day in the stock market, to doing a video on YouTube and you go, oh, it's terrible, stock market crash here. No, the view difference is massive. You get half the views on positive videos. You get a lot more, probably double the views on a negative video. The last video that I did, which was talking about a mistake, double the views on it. If I talk about a stock that's done really well, half the views. it's crazy. That's fear for you guys, and the difference between viewership as well from a media point of view as well. But anyway, what are these signs that are showing a little bit of weakness out here? So first of all, Kering. Kering is the first stock that we want to talk about, and once again having another dip, down 7% today as recording this video. And Louis Vuitton, LVMH, they also had another dip. It was down, was it 5% the other day? Overall now it's probably a little bit more with the drop that's on it as well today. What we're seeing once again, I mean, we've talked about Burberry as well. I mean, look at Burberry. I mean, that's like a cliff edge, isn't it? Look at that, 70% within a year. Oof. Brutal. So yeah, what we're seeing is luxury spending once again going down. Why does this matter? Well, the middle class. The middle class is being hit by the squeeze at the moment of inflation, wages, and then obviously interest rates, remaining very, very high. And that's stopping them from going out and spending. And we're seeing a lot of these luxury brands at the moment, that middle class that helps them a little bit, that higher middle class that every so often goes and dips into that luxury market, the middle class that dips into that luxury market isn't doing that at the moment. And that's affecting these companies. It's not just one company, it's every single basically luxury brand that you see out there is having a tough time. And that says to me it's not a company issue, it's a big slowdown. What I will say is that it does say to me that there's an opportunity here in the luxury market that I think that they will rebound in the long term. I don't know which one you go for. And in fact, we've talked about Kering before on the Patreon, and we did a stock request on it, and I actually said on that video, I still think you need it a bit lower. Once again, it now has gone a little bit lower, so is that now the time to buy? I'll have a relook at some of the numbers. LVMH, we're actually going to cover on the Patreon. We're going to do a stock request on that either today or tomorrow for you guys, and we'll have a look at that one. I think there is opportunities here, but at the moment it's not an opportunity. The squeeze continues in this area, and once again it shows that there's a slowdown with the middle class spending going on, which is not what you want to see. The next one that we saw this week that was another worry is once again earnings related. UPS had a big drop, as you can see here, down 13%, but you look at the numbers, I mean, this is where it gets worse. The EPS wasn't just a slow. I don't really get caught up on an EPS that's a little beat or a little miss, or a revenue beat that's a lot, or a revenue beat that's down. We know those numbers are roughly going to be there. The analysts are getting all this big data out there, and they're easily projecting where they're going to roughly be. So any up or down mark doesn't really bother me. The big thing is where you see big misses or big trends that are happening financially in a downtrend or an uptrend. And with UPS, we saw the big miss on the numbers. Like, it was a shock miss. And look, the EPS is missing nearly by 10%. The revenue as well, 440 million miss. We're not talking about a 123 million miss here. 444 million miss. That's a major miss on what we were expecting. The only issue I have with UPS is that it still remains at 21, let's call it 21 times earnings, and historically UPS has traded at about 20 times earnings, 21 times earnings. So I am still surprised to see valuations this high, considering how poor the numbers are from some of these companies. But with UPS, the big worrying thing for me, I don't know if I've actually got the screenshot of it here, but it was the volume. The volume in the US was okay. It was like a little bit of a growth, but internationally very, very weak. And we know the US has held up a lot better in this environment, but even that was slowing down, but the international was quite weak. And what we're seeing, this is a key indicator. If people are buying less, spending less, parcels are getting sent less, the economy is getting weaker, there's not as much money, transactions going on there, it's getting a little bit weaker, guys. And that was clear with the UPS numbers that were going out there. And that followed on for Visa's numbers. At some point, I've got to say, I've got to have a look at Visa and see where it is potentially a buy. I don't know if that's it with it going 10% low. It could be right now, but is it 10% lower, 20% lower, 4% lower? I've got to have a look at Visa's numbers and actually see where it's a buy. But once again, Visa's numbers, I mean, it's very rare you see Visa miss earnings, and that's what happened. That was a little bit of a surprise. The other surprise was the payment volume. The payment volume dropped from 8% down to 7%. So saying it's not worrying signs, and I think Visa is a quality business that will be around for many years, and if you ever do get it at a cheap valuation, I do think it's a buy. But what you are seeing once again is weaker numbers. We saw the weaker numbers from the luxury market, weaker numbers from UPS, we're seeing weaker numbers from Visa. it's all lining up together. It's not a coincidence that all these weaker numbers are all coming at the same time. And Tesla, obviously Tesla reported their earnings. I wouldn't really use Tesla as like a little bit of an indicator of where the economy is at, to be honest with you. I guess you could say that people aren't out there buying new cars, buying expensive items. So I guess you could use it as a bit of an indicator that the car market is a little bit weaker at the moment. But I mean, Tesla had a bad day yesterday. This was one of the big reasons why a lot of the indexes got pulled down, down 12.3%. In pre-market as well, it's looking like a little bit of a red day at the moment. But I think a few people got caught out by Tesla. I think that a few people have seen the rally in like the last couple of weeks and gone, oh look, there we are, we're rallying out, it's amazing, Tesla's going to do really well. And I kept saying, the rally, guys, this is a false rally. I said, financially, if you look at Tesla, the numbers are not improving, and that's the big thing you need to look at. And this rally here, all it is metric expansion. We need to see the improvement in the financials of Tesla, and we got the financials out, and we saw everyone kind of realized, oh, the rally that we've had in the last few weeks was just metric expansion. It wasn't actually financial related. And you look at the numbers. I mean, automotive revenues was down 7%. Fair play, the energy numbers were actually very impressive, but the profitability side of it wasn't good once again. You had the EPS down 46%, as you can see here on a GAAP basis. EBITDA was down 21%. And, this company already, it's not really growing. It's at 55 times earnings. But then you have the decompression of the EPS going on and the profitability going on. You're actually paying up right now 98 forward times earnings for Tesla. And it is, once again, I look at valuations in the market, guys, and I like Tesla. I've held Tesla shares before. I've made money off them. But I just look at the numbers and I look at the valuation and I go, I just don't know how you can justify 98 forward times earnings. Even if you look at the long-term potential of the company with these numbers right now. And I look at Tesla, and the big thing that I always say to Tesla bulls is like, because I'll have a few people commenting on this, like, you don't understand Tesla, even though I've made more money than they probably have ever from holding Tesla shares. I always say, right, the two issues you have is that everything that's being priced in at the moment is future thinking, like auto robot taxis and Optimus and all that. We have you can't really price that in until they contribute profit and revenue, and we have no idea what they are going to do from a profit and revenue point of view. So I don't know how you factor that in. The other issue that I have is that we've had 2 years of bad financials from Tesla now. So when we get to longer term, what are they going to grow at? I always see Tesla's bulls, they always say like, oh, it's going to be worth so-and-so in the next few years. But I go, but tell me what they're going to grow at. Tell me what numbers you think they're going to do. And none of them will give me numbers on what they do. They have no idea on growth or revenue or profitability, profit margins. It's all up in the air because we've had 2 years of bad numbers. And when we come out of this high interest rate environment and we look at the competition level and what actually of all this great plan is actually going to come to the bottom line, I don't know. And that's the big thing, is that I worry about the valuation here with Tesla and the numbers they're currently doing. I think it's a good company, but geez, it's a lot that you're pricing in right now. Anyway, that's getting on to a bit of a Tesla subject, and the whole point is about the stock market in general. But I guess another kind of point of view is that, weak numbers, showing a weak economy, but yet the valuations are still very high, which is the really scary thing. I got to say, I saw Elon Musk the other day. He actually put out about the humanoid robots are going to start working next year before earnings, and I was like, yeah, this is going to be a terrible earnings from Tesla when Elon Musk is coming out to protect the share price once again before earnings. I think even Matty on the Discord posted it. I actually put a short on Tesla before their earnings yesterday. Nothing serious, just a little bit of fun money. I think I put about £100 on it, and the short worked out as it worked out, and I got a free Nando's out of it. I was that sure that I was like, if Elon Musk is coming out doing his normal protecting of the share price, they're going to be horrible earnings, and it did work out. But yeah, it was funny, that one. But another weak economy, but yeah, the valuation is quite high. The only one that really surprised me yesterday was Google. Google's down 5%, but their numbers were actually the only one that I looked at and went, they were actually pretty good. They were good numbers. There was a good beat on EPS, good beat in revenue, but all the, like I said, the big thing is that they're all moving up in the right direction. The numbers are growing. You look at the revenue growth, 14%, 15% of constant currency. Operating margin expanded up to 32%. EPS, major improvement from the EPS. All the metrics are moving in the right direction, and the company's now at 22 forward times earnings. But obviously the shares were negative. Obviously one of the reasons why is because it was just such a red day. It's going to get pulled down, whatever, because of the red day. But as well, when you look at like a Google, I can understand why it's not bouncing up loads, because Google normally trades at 26 times earnings, and what's the company currently trading at right now? 27 times earnings. So it's about where it normally trades at, and it's actually doing the numbers that it should do for this sort of valuation. So yeah, maybe I expected a green day, maybe 2 or 3% up, but I never expected a big explosion from the stock because it's pretty fairly valued, That's why I've actually considered maybe do a trim a bit of Google, but like I said, I think it's a cracking company for what you do get here, and it's probably still going to go higher in the next 5 years. So do you sell it because of that? I don't know, but I could kind of understand why that wasn't as big of a reaction, but that was the only one that I looked at the numbers and thought they were pretty good. Don't know if it should have gone down potentially, but I didn't expect an explosive reaction anyway. But I did look at Google's numbers, and I was looking at Apple, and I still don't know how Apple has this sort of valuation. 33 times earnings for the numbers that Apple have just come off, and it's 33 times earnings, and then you look at the numbers that Google are doing at 27 times earnings, and it's down. I don't know. Sometimes the stock market absolutely confuses me, but overall, like the message from this video that I'm trying to show you is that most numbers out there that are consumer focused numbers, they're all very they're a little bit disappointing, a little bit weak out there. And yet I'm looking at all these companies that I've showed you then, and yet we are sitting at the moment at 29 times earnings on the S&P 500, which is way higher than we normally trade at 19 times earnings. We're not even talking like a 10% premium here, guys. We're talking like the valuation of the S&P 500 is like 50% higher than where it normally should be. And the metric expansion that the market has had at the moment is bonkers. And I don't know if it's sustainable. And I definitely don't think it's sustainable when you look at some of the numbers that are coming out from some of these companies at the moment. And the big thing that's really propped it up is, like I said, the AI situation, in my opinion. The AI is what's put everything at higher valuations. And how long does that last for? How long do companies keep putting all this money into AI? And I look at Google yesterday, and they mention AI in the conference call all the time, and I'm looking at them going, but you're mentioning AI all the time here, but I'm looking at what numbers are you doing from AI, and I never hear a company mention, our profit from AI accelerated 5x, 10x. Now, I'm not going through the Google conference call, so I might be wrong here what I'm saying, so I'm going to double check this, but it's what I'll be looking out for in the Google conference call when I do listen to it in the next, probably either today or tomorrow, is that I'm looking for, actually, rather than saying AI is helping us do this and this and this, and you're spending how much on AI, what benefit does that have for your business? That's what I'm going to be looking for. Because at the moment, I'm seeing weak earnings, an S&P at ridiculous valuations, companies' earnings getting weaker. And the only reason why I think it's holding up is because AI gets mentioned in nearly every conference call. But what benefits is that actually showing for any businesses? I don't know. So, like I said, for me, I look at what is out there. And I go back to the whole start of the video here when I talk about this stock market crash coming. Is the stock market crash coming? And I don't like saying, yes, there's going to be a crash, because no one knows. I don't know. I don't have a crystal ball. But if you're forcing me to say my opinion on the market right now, and what I've seen from Q2 earnings right now, is that I am more worried about where the stock market and the economy is today than where I were 5 days ago. And what makes me even more worried is when I look at the valuations and the numbers and the earnings that are coming out. I don't feel, when I was in 2023, people asked me, where do you think the stock market was going to go? I said that I think the stock market goes higher in 2023. I think you talk about the interest rates coming in, earnings coming back, the inflation starts coming down. I felt like we're in a positive place in 2023. 2024, positive, not as positive. I think a lot of is being priced in now. Mid 2024 now, yeah, this is the least positive I've been for a bit. I'm still bullish on the market long term. I think, in the long term you'll still be okay, but in the short term, could I see some pain? Yeah, I could see pain, because the weakness that is out there is getting stronger, in my opinion, and yet we are not seeing any positive signs from like interest rate cuts at the moment, which I think should have done 3 months ago. The earnings are getting weak, and yet valuations are getting higher. Valuations are getting higher on weaker numbers, which just does not make sense. You can't have a disconnect in the market like that. When we had a disconnect in the market like that in 2021, you know how it ended, guys. And I would just be cautious out there at the moment, because A lot of people getting hyped up because of AI in Nvidia, but when you look under the surface, it does look a lot weaker in my opinion. And if anything, in the last 5 days, I've got a little bit more worried on where the market is anyway. Hope you enjoyed the video, and guys, let me know what you think in the comment section as always. And thanks for watching. I'll see you in a bit.